You may have heard the saying that you should not keep all your eggs in the same basket. Well, this simply means that you should not keep all your investments in the same place, because if one part of the economy is affected, then all your investment is going down the drain. However, this might not always be the best advice. Hello and welcome to our channel, Essences. Today we will talk about why diversification is bad for your investment portfolio, or more specifically, why it can be bad if not done right. Now, before we talk about the cons of diversification, let's first clarify what it means. Portfolio diversification is a method of reducing exposure to risk by spreading your assets over many different asset classes. When possible, it's preferable to spin your investment risk over multiple asset classes and vehicles, as is done in a diversified portfolio. The theory underlying this strategy is that a diversified portfolio will have lower overall risk and higher long-term returns than any one asset or security would on its own. Studies and models reveal that the best cost-effective way to reduce risk is to invest in a diverse portfolio of 25 to 30 equities. Increases in the number of securities held produce additional diversification benefits, albeit at a much lower pace. The excellent performance of some investments can offset the poor performance of others, according to the diversification strategy of risk neutrality. Only if the assets in the portfolio respond differently, and often in opposite ways to market pressures, can the benefits of diversification be realized. Warren Buffett is considered to be one of the greatest investors of the era, and even he says that, quote, "Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing." Most financial investors will tell you to diversify your portfolio. Well, you may be wondering why so many people think that. They will tell you it is good for you, but what they are not telling you is that it is also good for them. Most financial gurus will recommend buying a diverse portfolio of stocks, mutual funds, and bonds, rather than recommending a single security or fund as a fantastic investment. Many of them have a bias because they are affiliated with a mutual fund business or financial institution, or because they have a personal investment in a certain stock or equity. Your employer-employee financial advisor will probably push you towards items that benefit either the firm or the advisor, like more commission. Now, onto why it is a bad strategy. Let's look at a typical diversified portfolio. So the biggest part will be invested in large domestic stocks. The next part would be domestic or corporate bonds, then comes international stocks, with additional investment into small-cap domestic stocks. Finally, we come to government bonds and real estate. The latter is a good investment if it generates income for you. Now, from a cursory look at this portfolio, you may think that this is a good portfolio, as the individual has a healthy mix of investments. But what you guys aren't seeing is that the majority of these are paper investments. Now, you may consider this diversification, but this really isn't that. Instead, it means investing solely in one type of asset class. Paper assets are a broad category that includes stocks, bonds, and mutual funds, currencies, money market funds, insurance plans, etc. By investing mostly in index funds, a 401k plan does little more to diversify the owner's wealth among stocks. False diversity. That's a specialized field. And if you go into it without any knowledge, you're taking a huge risk. You will lose everything if the paper asset market completely collapses like it did in 2008. Ask any retiree who lived through the Great Depression because of terrible timing, and you'll know how heartbreaking it can be. So, as you can see that a lack of diversification or an excess of it can both be problematic. A portfolio consisting just of stock holdings, even if spread out across a variety of diversified stock options, is considered to be putting all the eggs in the same basket. As Warren Buffett famously put it, quote, "Wide diversity is only essential when investors do not comprehend what they are doing. Over-diversification is a real occurrence that can happen. Each investment you add to your portfolio reduces your overall exposure to risk. But remember that reduced risk equals lower return. When diversifying too much, you reduce your return on investment, ROI, while increasing your exposure to risk. It's possible for over-diversification to have a regional flavor as well. When there are many investments in the same sector with similar historical performances, this is known as sectional over-diversification. Think about Pepsi and Coke as an example. Given the similarities between the two businesses, we advise choosing the more financially advantageous option. Over-diversification is not only inconvenient because of the time and effort it takes to monitor and manage so many different investments, but it may also be costly due to the high management and trading fees associated with so many different trades. You guys may be wondering now, what is the right approach then? Well, don't worry, we got you covered. Well, the first thing that you must realize is that you need to invest in things that you understand. So instead of investing in 40 companies that you think are good options, consider investing in 10 or fewer that you know are actually good and that you are not going to lose money on. Similarly, manage your own portfolio rather than buying some complex investment products that you don't understand what exactly is behind. Another thing you should keep in mind is that you should get out from investing solely in one asset class like equities and go towards commodities like metals. For example, physical gold is a pretty good hedge against inflation. Buying gold is actually holding real money, and you can spend it anywhere in the world. You could also buy silver. It's really about the things you want to buy and their potential return. We would also say that you should consider putting your money into real estate because of the positive correlation between GDP growth and demand for real estate. The property can be used as a hedge against inflation. Rising rents are a direct result of a growing economy and a shortage of available housing. Because of this, asset values are increased. By absorbing some of the inflationary pressure in the form of capital appreciation and transferring some of it onto tenants, real estate helps to preserve the purchasing power of capital, and it is a good option for generating passive income. However, liquidity might be a problem with this type of investment. Now, while on the topic of investments, let's not ignore an investment into a business system or platform that will also generate recurring income. Well, options in this category include things like writing a book, composing a song, or developing an app. But not everyone has the level of creativity to do this, so we recommend that you guys consider an automated YouTube channel. You would have to wait to gain subscribers, and you might need to pay for the initial content, but if you make the right moves, you will definitely have an income stream up and ready in no time. Oh, and while we talk about investments, don't forget to invest in yourself. This could entail going for a healthier diet, investing in programs that teach you marketable skills, and basically anything that is going to make you a better and more successful person. Cash equivalents are also a way to go. Government and corporate commercial paper, bank certificates of deposit, bankers' acceptances, and other money market instruments are all examples of cash equivalents. Each of these types of financial instruments is characterized by a low risk profile, a high liquidity market, and a short maturity. In the end, we will leave you guys with a quote from the famous and niche global economic forecaster Martin Armstrong. He said, "Wide diversification is only required when the investor does not have a clue about what is going on in the markets." We have asset allocation models for institutions that simply believe they must have some diversification. The main objective is to limit the areas they will take losses on because of diversification. Why buy government bonds when you know that we are at a 5,000 low? I'm sorry, but sometimes the allocation to a particular segment should be zero. In conclusion, while diversification is an amazing tool to increase your wealth and mitigate risk, it is not necessarily the best financial tool, as you need to understand its dynamics, without which you could end up losing a lot of money. So that's all the time we had today, folks. Hope you enjoyed the video. Do not forget to subscribe to our channel and do hit the notification bell to remain updated about all our future videos. See you all next time.